Hi, welcome to our Chapter 2 lecture on futures contracts. So the first thing I want to do is discuss what is a futures contract. So a futures contract is a standardized legal contract to buy or sell something at a predetermined price for delivery at a specific time in the future. So that's quite a mouthful. What does that actually mean? Well, I'm going to take the example of a COMEX gold futures contract. So what this does is it's a contract, so it's a legal document which specifies a certain amount of gold and a date at which that gold will either be handed over or received. And that trades at a specific price. So there's a specific price today for gold at a future date. So these contracts are traded anonymously on exchanges such as the Chicago Mercantile Exchange, the CME, a very famous exchange. And they trade continuously, have open, close, and fixing times throughout the day. One major advantage of futures contracts is that they're traded on margin, meaning that a trader gets leveraged exposure. So this is what we talked about before, this notion of leverage or increasing our exposure to a particular strategy. To demonstrate, let's focus on this COMEX gold futures contract. So I'm going to run through what you'll be faced with if you're buying or selling one of these contracts. So you'll have the contract size, which is the number of troy ounces of gold that you want to receive or deliver in the future. There is the price the contract is trading at. So maybe it's trading at $2,500.30 per ounce. There is the minimum price fluctuation on the exchange, so the minimum amount the price can move by, which is about $10 per contract. There's the contract months. This is the date that the contract will be delivered on, so either February, April, June, August, October, December. And rather than have an infinite number of times for delivery, we just have a fixed number of dates that can be traded, and that means we have a finite number of instruments which we can trade on exchange. The trading venue is the CME Globex. So this tells us where we can buy and sell the contract. The trading hours are specified here as between 6 p.m. and 5 p.m. Sunday to Friday, with a 1 hour halt daily at 5 to 6 p.m. And then there's the important concept of the settlement method. So this contract can be settled via physical delivery at approved depositories, mostly in New York. It says the delivery unit, which we know it gives some specification on the fineness. I'm not sure what that means. And it says that the gold should be cast in bars approved by exchange rules using registered refiners only. So there's a whole load of legal stuff built into this contract which specifies exactly what you get or give away at the delivery date. There's the last day of trading, which tells you when you can trade up to. If you don't trade the contract, buy or sell the contract before the last trading day, then you actually have to give physical delivery. And that's maybe okay if it's bars of gold, but if you've bought, if you have a number of cattle, so some animals that you actually need to go and take possession of, it's much more complex. So what people will do, generally, they treat these things like financial instruments where they will buy some futures contracts and then they will sell them before the delivery date and then move the position in the long position to a future month or future date, and that's called rolling the contract. So basically you give up your contracts before the delivery and start and purchase new ones in the next month. And as we said before, these contracts are traded on margin, which means you only need to put up a certain amount of money per contract in order to gain full exposure to the contract. So you'll register between $7,000 and $9,000 in the margin account as your initial margin. And then there'll be some maintenance margin which you'll have to post up to if you start to lose money on the contract. So this contract has a physical settlement, meaning that at expiry, a physical quantity of the asset will need to be delivered. And for this reason, as I said, people will normally move their investment to the next contract prior to expiry. The value of the near contract is stitched together then to produce a continuous time series of based on rolling the contract before expiry. So here we have the continuous gold futures price for COMEX gold futures from 2000 to 2025. And we saw last time that we took a strategy where we went long for, I think, from 2002 to 2010, and we had a Sharpe ratio of around 1, which we said was good given the low turnover from the strategy. So that's what you see here. There's this positive return from gold from 2002 to 2010. Okay, so what is trading on margin? Well, basically there are two types of margin that we need to be aware of. The first is the initial margin, which is how much money we have to put up to take the contract, to buy the contract. So suppose the initial margin for gold is $8,000 and the gold price is $2,500 per ounce, and the contract is for 100 ounces. Then we can get exposure to $250,000 worth of gold for just $8,000. So these contracts allow you to leverage your positions and get much more exposure. So once we've actually posted the initial margin and bought the contract, then we have to maintain the margin. So if there's what's known as the maintenance margin, suppose this is set to $7,000, then every time the value in our margin account drops below the maintenance margin, we get a margin call and we need to top up the account. So say on the first day, the value of gold drops by $50 per ounce, then our exposure to, we have exposure to 100 ounces, so we've lost about $5,000, and our initial margin in our account was $8,000, so we get a margin call for $4,000 in order to make the maintenance margin back up to that $7,000. And if the investor fails to post the margin, the contract will be sold and whatever is left in the margin account will be returned. So this trading on margin is one way that hedge funds get exposure to large amounts of risk and use leverage. So finally, I want to just discuss how do we value a futures contract. So what's the fair price for a contract that settles in the future? So there's a thing called the no arbitrage principle, and this underpins all of derivatives theory, and in particular for futures contracts, we can do two things. We can either buy the contract, the futures contract now and hold it until delivery, or we can borrow money to buy the underlying asset and store it for T days. So either buy the asset in the spot market now and just hold on to it and then deliver it in 2 days, or buy a futures contract to deliver in the future. And both of these options return the same product, so they should be priced the same by the no arbitrage principle. And if R is the daily interest rate for the borrowed money, and S is the cost of storing the gold or the underlying asset, then the futures price should be equal to the spot price multiplied by 1 plus the interest rate plus the storage cost to the power of t. However, in practice, there are deviations from this smooth geometric progression, particularly around risky events like interest rate rises and things like that. But essentially, we can look at the gold forward curve, which tells us for the different contracts along the x-axis what is the price, and here we see that based on this interest rate and storage costs, this is the future price of gold. So there are two bits of jargon here. One is when this curve is rising smoothly, we say the market is in contango, and when it's falling in the opposite direction, we say the market is in backwardation. So that's a very quick introduction to futures contracts, and there are some multiple choice questions which follow. So thanks for listening. I hope that's been of some help. Bye.